Jobs Day, like Bloomberg.
24 seconds away from the opening bow this morning. Good morning to you all. Going into that open, futures positive by 0.75% on the S&P. On the Nasdaq, up by 1.28%. We'll talk about Nvidia, the why behind that move, in just a moment. 4-day losing streak on the S&P, looking to bounce back from that at the opening bow. There's the opening bow. Switch on the board and get to the bond market. Yields bouncing off the back of jobless claims coming in below expectations. A downside surprise. That's what we call the right kind of downside surprise. Yields fade from 395 at the high, 396, 397-ish, 392.54 right now on a 10-year, up by not even a basis point. In the FX market, euro dollar from 105 to 106, positive not even 1/10%. Core CPI in the eurozone, record high, and crude looking to bounce back as well, 75.50 on WTI. We're positive there by about 2%. 25 seconds into the session, equities look like this on the S&P, up 0.75% on the Nasdaq, up by 1.1%. Consumer discretionary year today absolutely flying on the S&P 500, up by about 13%. Online retailers eBay, Etsy, Wayfair, all reporting earnings this morning, delivering a mixed bag of results amid a challenging macro environment. Abby has more.
Hey, John. Well, this is interesting because we do have on the day the consumer discretionary space actually flat, and it has to do with some of that declining action from specifically eBay and Wayfair. So it was a bit of a mixed bag here relative to eBay. They put up a small beat, but the outlook disappointed, and they also had declining users. Now, relative to Wayfair, down 8% on the year, up 50% though. So the quarter was priced to perfection. It didn't come in that way, a wider loss. They also saw a decline, 19% decline on a quarter-over-quarter basis in users. Now, relative to Etsy, a bit of a more positive view there. Mixed quarter, they beat sales. Profits were down though. Analysts liked it. Price targets raised. And you can see there the sales growth for Etsy impressive, up 13%. But for Wayfair and eBay, not so much. And relative to those declining user bases, eBay, their declining user base has been over the last 7 quarters in a row, but they've also, for the last several fourth quarters of each year, they've seen a decline, and that's the big December quarter. So it seems as though eBay are folks, consumers, users relying on eBay less during that all-important holiday quarter.
eBay down 5%. Abby, thanks for that. You want to move? Here's a move. Nvidia up more than 12% in the early part of the session, giving an upbeat forecast with its push into AI, helping to offset weakening PC demand. The CEO saying this: it's a wake-up moment for the capabilities of AI. This is really where we can be of great value for the industry. Isabel Lee has more. Hey, Isabel.
Hi, John. It's really all about guidance when it comes to earnings, and investors are rewarding Nvidia for that. The company gave a bullish outlook for the first quarter on the back of a strong AI push that it said would offset the sluggish demand in personal computer chips. So Nvidia said that it expects first quarter sales to hit $6.5 billion. That's more than the fourth quarter and slightly above consensus. Obviously, Wall Street is cheering the forecast despite overall revenue declining 21%. As you can see on the chart, it's the second decline in 13 quarters. Still, shares are jumping today, and it's already the best performer year to date with the S&P Tech Index, just slightly behind Meta. And perhaps to the point you made earlier, it's helped by the recent AI view. We have the CEO and co-founder Jensen Huang saying that, interest in ChatGPT has opened the eyes of business leaders to the power of artificial intelligence. And if you're wondering why the holiday season didn't do so well, it's because gaming fell by around 46%, but it did top earnings estimates average still, though. John.
Isabel, thank you. What a move year to date and on the session as well, and worth considering it is the 4th biggest weighting on the Nasdaq 100. That's behind much of the move we're seeing this morning. About 3 minutes into the session on the S&P, we're up by 0.8%. The broader Nasdaq Composite up by 1.1% on the Nasdaq. Let's stick with tech. Shares of Alibaba surging after delivering better than expected results. The company's CEO expecting China's reopening to fuel near-term growth, saying this: all of our merchants express the strong desire to get back to business. We expect that this recovery will continue. Everything is now quickly getting back on track. Katie Greifer with us with more. Hey, Katie.
Hey, John. Well, we're already seeing a recovery on the earnings front. If you look at profits, there was a big beat there. That measure surged about 69% to about $6.8 billion. And of course, that's partly thanks to cost-cutting measures. We got that in the form of layoffs last year to the tune of about 19,000 jobs. Now, those were designed to boost, quote, high-quality growth last year, and that continues to be the focus for Alibaba. They're prioritizing profitability rather than new business expansion. And today's rally, we're talking about 3.5% right now. It's helping to further rebuild Alibaba's market cap. Now, since October's low, Alibaba has added about $84 billion back to its value, which currently clocks in at about $250 billion. And as you can see, that rebound is dwarfed by Tencent, but still comfortably ahead of rivals such as Pinduoduo, such as you can see Baidu there as well. And that's the case even with Alibaba's relatively rough month. Again, we have shares up in a big way from October, up about 50% from that low, but that gain was about 90% at its peak. And it's worth noting that Alibaba is still down about 10% over the last year, John, so a bit of a hole there.
It's funny, I picked up the exact same chart as Katie. Katie, thank you for that. So off that October low, we're still up by about 54%, including today's move. But to Katie's point, the high at the end of January, we were off that low by something like 91%, just a phenomenal move. For the broader market then, 5 minutes in, we do get a bounce. We snapped the 4-day losing streak, at least for now, on the S&P up 0.7%. Here's the take from Jonathan Golub at Credit Suisse. This is what he has to say. The best way to describe this environment is stagflation light. I'll get to that term in a moment. 3 to 4% inflation with slow growth but abundant jobs. It looks nothing like the 70s, but it's a challenge for equities. Jonathan Golub, I'm pleased to say, joins us right now. So John, let's go there. Stagflation light. I see great growth right now. What do you see in the future?
Well, if you look at the consensus based on the Bloomberg survey of economists, we're looking at 60 basis points of GDP this year. And next year it gets a little bit better, but not a lot. And there's two things that are dragging on the economy. The first one is if you're a business that wants to expand, you can't find workers. And that's a headache. And the second one is that the Fed is tightening enough to really slow down the economy and take some air out of the tires, but not enough to throw us into recession. Now, John, last time that you and I talked, we said, what would guys like me want to see more than anything else? You crash the economy, you have a real recession, you have a big V-shaped bounce, and it's a cycle that we know exactly how to think about. This is much more challenging.
Well, talk to me about what that means for discretionary. That's the winner year to date, 13% year to date on the S&P. How do you think about that, John? At the moment, up 13%.
Yeah.
If we go to your world of 3 to 4% inflation, slow growth but abundant jobs, where does that leave discretionary?
It's actually my favorite sector for this type of environment. Just think about what the consumer is facing. Last year, wages went up 3 to 4%, but inflation, CPI averaged 8%. So the average American went to the store, got a raise, and realized it didn't go as far as he wanted. This year, he's getting a raise of 5 to 6%. If you're a retiree, your cost of living adjustment on your Social Security or government pension is up 8%, but inflation is expected to be under 3% at the end of the year. So the consumer is going to feel surprisingly empowered in this environment because wages are running hotter than inflation, or they will be throughout the course of the year. The other thing is, with jobs abundant, you have this really golden environment for consumers. It's one of the reasons why that both the University of Michigan and the Conference Board consumer confidence surveys have been rising steadily since last June, because last year was really a year where companies won over labor, and this year is one where labor wins out over corporate profits and companies. So there's a real shift in the in how things are playing through.
Well, John, let's talk about the winners and the losers around that story. The airlines year to date, American Airlines up 22%, United up 32%, Delta up by close to 15%, 14% higher. Do you see reasons for that to continue?
Well, first of all, as I said, I think the consumer will increasingly have more discretionary income. A lot of people are talking about the need for consumers to tap their credit cards and how much further can that go. But the real issue here is that wages are much stickier and staying at a higher level, and the general level of inflation is coming down. So what does someone do who has extra cash? They've already paid for their food. They've already paid for their health insurance and their rent. They get on a plane and they go someplace. As a matter of fact, I think the group that looks the most that's the most empowered in this environment are seniors that have a pickup in their cost of living. And what are they likely to do? They're likely to go, on a river cruise gambling, or they're likely to go, on something where, something like like I said, like a cruise, where it's particularly well geared for them. And if you look at how the cruise lines have done this year, they've just been on fire. And I think that this is part of that theme.
Labour pressures, we've talked about that, you've mentioned it. So Labour feels like they have the power, the markets might be compromised. Home Depot, Walmart early this week, Home Depot basically warning that there's going to be some labour pressure that might hit margins. That was the take from a lot of analysts. John, are they the losers in your world?
Yeah, I mean, if you think about this, the way an economist would describe it is you have a certain amount of economic growth in dollars. And certain years, it goes to the owners of capital, and certain years, it goes to labor. For the last 25 years, the owners of capital, companies, have been the big winners, and labor has stagnated more. The next year or two, it's going to be the opposite. And so, this from a policy perspective, people have wanted the economy to rebalance so that the average American sees their own situation moving ahead in the same direction as the stock market. And it hasn't happened that much in the last 25 years. But in this environment, that's exactly what's happening. Labor is coming out ahead. And I haven't really heard policymakers talk about this as a win, but I think it probably is.
It would be a win if they talked about it,
Sure.
but they don't really talk about it that much. I think that's the objective, the ultimate objective. So, John, we live in a world where the economy might look good and the market might look bad. Is that the takeaway?
Yeah, I think it is, John, is that the corporations, first of all, in this environment where the consumer feels pretty good, you don't get a recession. So that's one of the real positives for the stock market since the beginning of October, is that the likelihood of a recession in the picture I paint is much lower. And if you don't have a recession, it's truly not bad for the stock market. On the other hand, corporate profits, the expectations for how they're going to do in 23 and 24 continue to fall. And it's not a revenue problem. It's not that people aren't spending. It's that corporations are getting squeezed on profit margins. And that's going to be the story. This earnings season, earnings are up over 5%, margins are down 9%. That's directionally what I think the rest of the year is going to look like. Sales good, profits weak, and people are going to be really confused about that, but it's all about wages.
So, John, right now in the S&P, 4,016, 4016. Your year end is 4050. Given the
Right.
risks we've talked about, given the weightings of the S&P 500, each company is going to experience these themes in different ways. A risk skew to the downside?
I think the overall market's probably going to be flattish. And it's really interesting how well the call is working out. And, in the beginning of October, when we put out this 40-50 target, our expectation was the stock market would move very rapidly higher as inflation settled down a little bit, as recession risks eased. But that once we got into the beginning of this year or the middle of this year, that the upside was going to be capped, and I think that that's probably true. But there are winners. So talk about winners and losers. Defensive stocks, those that do the best when we go into recession. If you're not going into recession, you don't need to be in consumer staples or utility or healthcare. So I think that they're laggards, and they haven't done all that well, generally speaking. Consumer discretionary, even though the overall economy is sluggish, if the consumer feels better, those names do pretty well. And you were talking about the airlines, we were talking about cruise lines. Those do fine. Tech companies are really struggling, and that's kind of a somewhat different story. But I would love to be buying tech right now, but the earnings picture there is somewhat challenged, especially at the biggest tech companies.
And so many people have been doing just that so far year to date with big runs already. John, this was wonderful just to get a breakdown of your framework for thinking about this market. Jonathan Golub there of Credit Suisse. Year to date, the Nasdaq up by close to 11%, on the S&P 500 up close to 4.5%. Coming up, more cuts in tech and finance.
We know that there are structural things that have happened to the labor market that aren't going to be easily fixed. Now, on the one hand, that's good for consumers, but it's also not good for the consumers who end up losing their jobs because margins are getting pinched.
This time, it's Wells Fargo and Meta. That conversation up next.
Margins are going to continue to be pressured by wage growth for a bit longer. And we know that there are structural things that have happened to the labor market that aren't going to be easily fixed. Now, on the one hand, that's good for consumers, but it's also not good for the consumers who end up losing their jobs because margins are getting pinched. I think at the end of the day, that's one thing the street is struggling to understand is what is the new normal in terms of labor.
So it's hard to get your hands around this. We had claims earlier this morning at 200,000, sub 200K, but just in a couple of industries, finance and tech, the layoffs keep piling up. Wells Fargo cutting more than 500 jobs in its mortgage unit, adding to the thousands of cuts from last year. In big tech, the Washington Post reporting in the last 24 hours that Meta plans to reduce and reorganize thousands of workers. Shonali Basak joins us now here in New York alongside Mandeep Singh. Mandeep, first to you, the story we're familiar with now in tech, more cuts.
Well, so and it's not surprising because tech companies have high fixed costs. I mean, if you keep aside the Uber, Lyft, and the ride-sharing companies, most of the times they have a very high operating leverage because, you know, in times when revenue growth is strong, the fixed cost model works quite well. The problem is when the revenue growth starts to taper down, which is the case, you know, with all the consumer tech companies, the fixed costs become a problem because it shows up in the margin degradation, and that's why you see another round of cuts possibly at Meta, and I don't think it's good for, you know, the morale or just retaining talent. So I do see as a problem when companies have multiple round of cuts.
Mandeep, given the excess hiring we saw in the pandemic, are we closer to the beginning of this or the end?
Well, so I would say we probably have a few quarters to go simply because in the case of Meta, it looks like a structural problem. We saw that, you know, with Apple changing its policies around privacy, that hurt their ad pricing. Now they're tinkering with a subscription model, you know, charging creators for using the tools on the platform. And those structural issues take time to resolve. I mean, maybe Meta may not be able to get to that 20-25% top line growth level again. And that's when they have to think about how they can right-size the costs, and that's what they're doing here.
Shonali, in tech it's thousands, tens of thousands. It's far more incremental with these banks. What are you seeing, Shonali?
It's drip by drip, John, and remember, some of this is because of slowing growth, slowing business at many of these firms. You saw that over at Goldman Sachs be part of the case after years of headcount increases. But remember, some of this you have to recognize is also strategy shifts as some of the market fundamentally changes. When you're looking at Wells Fargo, and particularly that's certainly the case because not only are the mortgage markets really hammered here, you also have this secular move from the mortgage markets away from the big banks and lending into other places instead. So when they're cutting jobs here, it's not just about boom and bust. It is about changes in the environment itself. The question here then becomes thousands last year, hundreds this year. Who else is yet to come? The mortgage market is a very clear space where there's a lot of pain. You saw those cuts at JP Morgan as well, but do those cuts become deeper elsewhere? It's a very close thing to watch after watching Bank of America announce hundreds as well after holding on for dear life for the last couple of weeks and trying to preserve those jobs. Does it get deeper?
It's incremental, but we're seeing it more and more. Shonali, thank you. Alongside Mandeep Singh, to the both of you, just fantastic. One name I wanted to pick out, Tesla. It's up in early trading by about 1% so far, last time I looked. Year to date, it's absolutely flying, up by 65%. The latest news from the company, the EV maker announcing it will set up its global engineering headquarters in Palo Alto. This coming after years of Elon Musk essentially bashing the state of California. Bloomberg's David Welch joins us now with more. David, what's the latest?
Yeah, so they've named California as their engineering center, which isn't really a huge surprise, except that Elon has been fighting with the state, criticizing the state. He moved the headquarters of the company to Austin, Texas, and has expanded the footprint there. But Tesla still has about 46,000 employees in California. And if you look at it, if you're trying to develop electric vehicles, you're trying to develop self-driving vehicle technology, the talent base is still in the Bay Area, Silicon Valley. So if Elon wants to continue developing all of these things, and he does, he's got to have an engineering base there because that's where the people live, and it's going to be tough to get them all to move to Austin. So I think this is about talent and about having an existing base already in the state.
David, do you think that story is changing, though? We hear that talent argument a lot, but ultimately, given the hybrid nature of working for so many people, particularly on the West Coast, is that changing at all?
It is, and Austin has a pretty good talent base itself for technology. But when you're looking at code writing, things like that, I think with this announcement, he's got, let's say, big footprint in each state. So people can work in Austin, people can work in California, they can collaborate virtually, they can fly back and forth. It's not a long flight. I think he's probably playing both ends of it here, which is a smart thing to do because you do have talent pools in both areas.
True. Good point, David. Thank you. Stock's up by about 0.7% now. The broader market, about 23 minutes into the session, is up 0.8 on the S&P, and the Nasdaq doing okay, better than okay, up 0.9% with a sector price action. Here's Abby.
Well, we have very strong action, not surprisingly, today, John, with that S&P 500 up for the first time in 5 days, and it has everything to do with NVIDIA and big tech. NVIDIA up 13%, the best day of the year. Technology, the best sector, up 1.76%. We have a few other sectors up about 1% or more. The only sector down, communication services. This as Netflix is down about 3% on a report that they are cutting subscription costs in many countries. As for the last month, well, because of the move that we're seeing higher for technology, despite rates going higher, discretionary and tech higher, utilities and energy lower, a little bit of a flip of last year.
The broader market higher. Abby, thank you for that. Up 0.9%. Your trading diary up next. Attempting to break the longest losing streak of the year so far in the S&P. Over the previous 4 days, we were down every single day to a total of about 3.9% into negative territory. We bounced back from that, up 0.9 on the S&P, on the Nasdaq, up by 1.3. There's the price action. Here's the trading diary. What you need to be looking for. Commerce Secretary Gina Raimondo speaking at noon Eastern Time. Fed speak from Bostic Daily. Then Jefferson, Mester, Bullard, Collins, Waller all speaking on Friday. Plus new home sales, PCE deflator, and income and spending numbers to round out the week. That rounds out this morning for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg TV.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Thursday, February 23rd. Here are the top market stories we are following for you at this hour. Are we aligned? Stocks rebound as the Fed minutes jive with what the market had already priced. Is there more room for any hawkish shocks? AI aids NVIDIA. The chipmaker jumps on a strong forecast, signaling the push into AI processors is offsetting a PC slowdown. The stock's value is now up nearly $200 billion this year. And the view from Cliff Asness, the AQR Capital Management co-founder, joins us exclusively with his take on value investing bubbles and what keeps him up at night. From Washington, D.C., I'm Kaylee Lyons, along with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, we begin the show today with some breaking news.
Yeah, let's talk about what is happening around the World Bank. The United States, Washington, D.C., where you are, has announced that it is going to nominate the ex-MasterCard CEO, Ajay Banga, as the World Bank, for the World Bank president. Obviously, that would be to succeed David Malpass as the World Bank chief. We'll get more details on this in just a moment and consider why he is the right person to proceed forward for this job. But as you say, Kaylee, the other story that we're very much focused on right now is what the data are telling us, how the market has moved, what have we priced in, what have we not priced in. Here's my take on it. So I laughed out loud when I saw the data today, the claims data and the PCE inflation data. Honestly, I laughed out loud. Who would have thought that this was an economy that could have taken these kinds of rate hikes and delivered this kinds of data? So that's kind of the starting point right now. The market clearly thinks, Kaylee, the market clearly thinks that it is now priced in the Fed. My question is, has the Fed priced in the data?
I think that's a really good point, and today's data exemplifies the necessity to answer that question, Guy, because if you get 192,000 prints on initial jobless claims below economist expectations, and yet the pricing data still hot above economist expectations, we're talking 4.3% on core PCE. It speaks to a labor market that is still strong, inflation that is still persistent, and monetary policy that doesn't look like it is really fully kicked in yet.
Well, let's kick it around a little bit. Let's try and get some other views on what is happening here. We need to get Mike's view on what is happening with the World Bank as well. So the question of the day, are the hawks priced in? And the next question, kind of element to that, as I suggest, is the data priced in? Joining us now to discuss this, Bloomberg's Mike McKee and Kriti Gupta. Kriti, let me start with you. We'll get Mike's take at the end, maybe, on what is happening with the World Bank. So let's just start trying to answer this question first of all. The market clearly now thinks that it has priced in the hawks of the Fed. Is that correct?
It doesn't feel correct, and I think one of the reasons you have to look at is not necessarily what Fed swaps are pricing, which, by the way, you're looking at about a peak policy rate in July, I think about 5.5%, 5.6%. So you are seeing an inch higher and higher, but I think the best gauge to look at is what is going on with the bond market, and specifically the 10-year yield, because of course we know it has been trading in a little bit of a range, but now you are starting to see the 10-year yield struggle to hit that 4% level, and the folks I've talked to around a lot of these trading desks are waiting for that key round number of 4%, for a more sustainable equity turnaround or equity sell-off, and that is really what we haven't seen yet. We've seen yields inch higher. We've hit 392, we've hit 390, but mostly driven by technicals as opposed to a real fundamental change in pricing. I think what's important, though, is also the equity market just isn't as sensitive to the bond market as it was in 2022. That narrative of yields higher, tech lower, it's not there anymore, simply because there's this idea that perhaps the carnage of 2022 was overdone, and if there is 50 basis points potentially back on the table, the Fed having kind of a step-up approach from 25 to 50 is a really unlikely scenario.
Yeah, it's a good point, that kind of correlation breakdown. And right now we're looking at a 10-year yield just shy of 391. So, Mike, to turn to you with this question, whether or not the hawks are fully priced in, I guess another way of phrasing it is how much more room is there still for any kind of hawkish surprises?
I don't think you're going to see hawkish surprises other than in data, perhaps, that may drive some people in the markets on their trading. For the Fed, it's not time to make any decisions yet, because you've got another CPI report, another jobs report, another retail sales report before their next meeting. We won't get another PCE, but well, we get one tomorrow. The quarterly PCE number today was revised up largely because of seasonal adjustment factors, the same ones that were put into the CPI and changed their outlook, and also the retail sales numbers. So we probably want to wait and see what tomorrow's January numbers look like, and then the Fed is going to wait until they have to make a new decision on where to price the final terminal rate and how fast to get there.
Mike, do you think the market is priced for a Fed of 3 weeks ago, or do you think the market is priced for a Fed of now?
Oh, you look at the yield curve movement, and they're clearly priced for a Fed of where they think they are now. We will have a much better view as the data come in and members of the Fed talk about it. We did have Loretta Mester say that she was one of the people who wanted or who thought there was a case for 50 basis points at the last meeting, but she also said if she'd been voting, she wouldn't have voted for it because she wouldn't have wanted to surprise the markets. So if there's going to be that pressure to move to a 50 basis point move, A, it'll come up in the markets first because they'll see the same data the Fed does, and B, the Fed will reinforce that opinion. So it's too early to say what we're going to get in terms of speed or what a terminal rate is, because 3 weeks ago the Fed thought the economy was at a different place than it is right now. 3 weeks from now, who knows?
Well, and Kriti, obviously the end goal of all of this for the Federal Reserve is tighter financial conditions. We have seen some of that tightening taking shape over, say, the last week and a half. To what extent is the market doing some of that heavy lifting for the Fed that it may end up having to do less?
Well, it's doing a good chunk of it. Look, I think there was a big call in October, specifically by Mike Wilson over at Morgan Stanley, the CIO there, who really said there's going to be a shift at some point from the macro to the micro when it comes to the equity market. And I think you're starting to see that shift about 5 months later now in about the end of February. What's crucial here is this idea that a lot of the earnings picture is driving the trade. If you actually look at the information or the data today, for example, it's not necessarily jobless claims. It's not necessarily the GDP revisions that's driving the equity market. In fact, it was a blip when you look at tick-by-tick trading. Instead, you're seeing the NVIDIA earnings story. You're seeing the Wayfair earnings story factor in more to the equity trade than the macro one. And I think this comes back to the idea that when it comes to kind of that restrictive policy, look at a lot of what the experts are saying. They're saying, well, maybe that lag that the Federal Reserve policy has on the markets, maybe that lag is way shorter than we thought and really showed up more in the fall of last year than it is in the spring of this year.
Mike, let me wrap things up with you. I want to get your take on Ajay Banga as a replacement for David Malpass. That's what the White House wants. What do we know about his credentials for the job? Why is he the right person for the job, do you think, in the White House's mind?
Well, the World Bank's job is economic development and poverty reduction, and he's spent a lot of his time when he's not been running MasterCard or right now his job as vice chairman of General Atlantic on these kinds of issues. He's been a co-chair of the Partnership for Central America, where he worked closely with Vice President Kamala Harris on efforts to bring business and development to Central America to try to stem some of the refugees flowing north to the United States. But he's also worked very closely with microfinance. He was at Citigroup heading their strategy on microfinance for a number of years. So he's familiar with the whole process of poverty reduction and economic development, and at the same time has a lot of management experience in his time at MasterCard. Interestingly enough, Guy, he went to a school in Hyderabad in India that has produced not just Ajay Banga, but also Shantanu Narayan of Adobe and Satya Nadella of Microsoft. So they've all gone to the same elementary school, private school in Hyderabad, India.
All right, really interesting stuff. Mike, thank you for bringing us some of the context around that nomination. Bloomberg's Michael McKee and Kriti Gupta for joining our roundtable today. Thank you both very much. Now coming up, we'll have more of our question of the day. Are the Hawks priced in? We'll talk with Mark Connors of 3iQ Corp next. This is Bloomberg.
Today, the global spotlight is on India as the G20 financial leaders gather. Among the issues on the table, debt relief, inflation, climate sustainability, and more. Live coverage continues on Bloomberg, your global business authority.
All right, stocks are attempting a rebound today after 4 straight days of losses on the S&P 500 as markets have tried to come to grips with a repricing of expectations for the Federal Reserve. So on that note, let's get back to our question of the day. Are the Hawks now priced in? Mark Connors, head of research at 3iQ Corp, joins us now for more. So Mark, what do you think?
Hey, Kaylee. Yeah, I think the hawks are priced in. We look at the volatility structure right now as focusing more on rates. The VIX is like a Twinkie. It's appealing at first. It provides no nutritional value. For the last 10 years, you really had to look at the MOVE index. And when that popped, equities retreated. So we see right now there's going to be a decline in this equity kind of bounce. You know, we had February being a big sell-off since that February 3rd unemployment number. But our indicator, which was the S&P versus U.S. 10-year correlation, it's so simple. It's not that complex. Our team, and I've used it since 2007, and it reversed February 2nd before the February 3rd release. So are the hawks priced in? I would say that they're 80% priced in. I'll put that number out there. I think there's still some movement. When you have euro dollars move 1 point across the curve in 2 weeks, you know, I still think there's some digestion about what exactly happened in February with unemployment.
Mark, good morning. It's Guy. We continue to chase the data, though. The data continues to confound all of us. It continues to confound the Fed. It continues to confound, it seems, all central banks. The data continue to hold up. We've just seen data today out of the United States on claims. You've got inflation data out today as well on the quarterly basis. We're going to get more of that tomorrow. The Fed is struggling to have an impact here. Therefore, it's going to have to go further. So, yeah, the hawks may be priced in for now. Do you think the hawks are ultimately going to have to go harder, fly higher?
Guy, I like you holding my feet to the fire because you're right that if you were just to look at euro dollars, they're going to be so variable. So let's take a step back. We've talked about inflation only when Russia invaded Ukraine. That we've had asset inflation for a decade. But when it hit our kitchen table, our gas tank, and our HVAC systems, and all of a sudden discretionary income went down, that's when it became a problem. So I mention that because going back to your question about do we chase the data? No. There's a structural change. We are going to have debasement of fiat, period, going forward at a higher rate than we've had in the prior 50 years. That's structurally there. So what are people doing? Look at Ira Jersey. This morning he's like, forget 210s. It doesn't hurt banks anymore because they're all front-end loaded with their assets. So businesses are changing. That's why Walmart can hire, because they're adapting with technology to the higher structural inflation. So that's my 5 cents. You have to look at, you have to change your behavior, and those who do it will win.
Okay, so Mark, if we're talking about structural changes, does that also mean returns in the equity market are just going to be structurally lower going forward because we now live in a different world?
Yes, we are in a third regime. Howard Marks talked about it a bit. Instead of zero rates, which we have a measure, GDP versus the Wilshire 5000, just to say, hey, shouldn't they be related? And they were. For 40 years, from 71 to 2010, they ranged between like 0.7 and 1. Like GDP was 16 trillion in 2010. The Wilshire 5000 was 16 trillion. But that ratio almost hit 2.5 times last year. So equities are not going to have the same type of buy dip. We're not going to have, PE ratios at 30 in the near term. But they are a better store of value than the front end of the curve. And I think that we are going to have rates go into that 2 to 4% as a long term because there are growth headwinds. So we have two economies. We have the real economy, which is slow, and we have the financial and hard asset economy, which is just still very persistent and is where investments should be, I think.
So in terms of rebalancing those, what happens? You talked about the Wilshire versus GDP. If we're going to rebalance back to something that is more consistent with the long-term trend, Mark, what happens here? Does GDP come up? That looks like it's going to be a struggle right now, but I guess on a nominal basis with inflation doing what it's doing, maybe it will. Do asset prices just go sideways? How does the ratio realign?
Right now, you need to have dry powder, and I forgot who the woman you had on just before, Hunt, I think, spoke about putting 5%, getting that 5% front end duration while you wait. I think we're in a certain, everyone said we're in an uncertain. The data doesn't help. We don't know what's going on. We haven't had inflation. So get paid 5% with whatever, 20, 25% of your portfolio. You still need to have a house, hopefully. You need to be in the equity market, but you need to pull money to the front end because we don't know where we're going right now.
And Mark, finally, we just have about 30 seconds left, but there's been some back and forth over the last week or so on the possibility of a Volmageddon 2.0. What do you see?
Not in the equity market. We've been popped 3 or 4 times with COVID, starting on like March 17th when you had the Treasury market almost go kerplooey. And we've had the PE taken down. So if there's a Volmageddon, I think it's more in rates or credit. So no Volmageddon. I think you had someone on earlier saying that raise to the third power. No, but look at rates and look at Treasury volatility. I'll leave the last part. The money supply has doubled its volatility from a trailing 50-year average. That's something that's worrisome.
Mark, we're going to wrap it up there. Great to catch up. Nice to see you in Canada. Thank you very much indeed. Mark Connors, Head of Research at 3iQ Core. Still ahead, NVIDIA surging on its bullish outlook. AI is making up for sluggish PC demands. Details next. The startup is coming. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. U.S. claims for unemployment benefits unexpectedly fell to the lowest level in 3 weeks. Initial jobless claims decreased by 3,000 to 192,000. It's another sign of unrelenting tightness in the labor market. J.P. Morgan collected more in overdraft revenue last year. That's despite changes designed to limit it. It's a sign that once more, customers are having trouble keeping their accounts flush with cash. J.P. Morgan took in more than $1.2 billion in overdraft fees, a 3% increase from 2021. Bank of America's overdraft revenue fell 65%. And shares of Alibaba are higher. Profit at China's e-commerce giant soared 69% last quarter. Alibaba kept the lid on costs and shoppers continued to spend online while the pandemic raged. Still, revenue increased only 2.1%. Some investors worry that a sustained recovery in Chinese consumer spending may take time. And that is your Bloomberg Business Flash. Kaylee.
All right, Angel, thank you. Guy, I've been with you for a couple days now and we haven't talked about crypto, so now I am going to hit some of the news related to that. They'll be talking about this here on the East Coast as well as on the West Coast in San Francisco, which we're seeing a beautiful live shot of now. But this relates to Sam Bankman-Fried, of course, the founder, co-founder of FTX, who has been accused of fraud. We had new charges unsealed today in relation to that. A 39-page superseding indictment was unsealed today, adding 4 new counts, including citing co-conspirators without naming them, as well as bank fraud charges, violations of law in money transmitting operations, and demands for the forfeiture of assets. Again, new charges being unveiled against Sam Bankman-Fried. So that is the story we will continue to stay on top of in the crypto and tech world. But there's other tech stories to keep an eye on as well. And given that it's about 20 past 7 or so on the West Coast, let's get to the startup with our very own Ed Ludlow, one of the co-anchors of Bloomberg Technology, because there are other stories at work here this morning, Ed, including NVIDIA. Thank you, AI. We are seeing a huge move in that stock today.
Yeah, we're up around 14.5%. A gain of 15% would be the biggest jump going back to March 2020. Currently, the stock up intraday most since November. Basically, NVIDIA's AI moment has come, right? This is a leading chip maker that makes graphics processors principally that have been so ahead of the game when it comes to graphics processing, gaming, and data centers. But what we're seeing is evidence in this bullish forecast they've given that demand is starting to come for their processors in the realm of artificial intelligence. In other words, they've just got really superior compute power. You can handle multiple data processes in parallel and use those GTX machines to train software to act in the way that artificial intelligence does. And you know, in an interview with Jensen Huang, the CEO, he kind of is modest about what's happening, but it's an inflection point where companies are realizing that AI matters to them broadly. They know they need to invest, and his kind of, I guess it's not shade. Shade's a bit unfair, but he talks about OpenAI and what we're seeing with ChatGPT and makes the point that that is a AI platform for everyone. But if you're a business, you need something more tailor-made, and you need to get the compute power to do that, and the share's clearly reacting on analyst reaction and investor reaction positively.
Ed, is NVIDIA really an AI company, or is it just ahead of everybody else right now? I'm just wondering whether or not this is the company looking for a proxy to play this story through, whether it's the market looking for a proxy to play this story through.
What's interesting, I think, you know, you always have to be cautious of looking at the share reaction and balancing it with, I guess, the sell side analysis. But a lot of the sell side notes point to the idea that the core data center business is bottoming out and that there's weakness in the PC market and some other end markets. So this is kind of papering over some cracks. They're caught up in the euphoria of AI. That said, there is really tangible evidence that it's providing new growth opportunities, as Piper Sandler put it. And other banks are kind of recommending that you hold the shares because actually NVIDIA is super well positioned to be at the forefront of jumping on demand when it comes. Basically, their chips are superior when it comes to processing data. And what they also did was announce their own cloud service, where they go to the cloud providers and say, don't do the infrastructure yourselves, use our machines and we'll partner on it together. Another potential revenue stream for them.
Ed, just quickly on ChatGPT in particular, I was reading this morning about China cracking down on that in particular. Is regulatory scrutiny going to come for AI in the not-so-distant future here in the U.S.?
I would say we've covered the ChatGPT OpenAI issue every day since the first week of November on Bloomberg Technology, and every day, whether it's a venture capitalist or a market participant or a startup founder, say yes, there will be regulatory scrutiny. But that said, you know, there's relative transparency about the shortcomings of AI. On the China issue, remember a big part of that is that you have Tencent and Baidu are also trying to give their own ChatGPT equivalents in that marketplace.
Ed, as you say, it's been around for a while. Everybody's now getting very excited. It's going to be something I suspect we're going to be spending a lot of time talking about. Ed, great stuff. Thank you very much indeed. Ed Ludlow with the startup. Coming up, 2022 was a record year for Cliff Asness. His longest running fund, having such a great move. He's joining us exclusively next. This is Bloomberg.
We are an hour into the U.S. trading session. We are attempting to snap a relatively long streak of losses. Bloomberg's Abigail Doolittle is tracking the moves for us. Abigail?
And Kaylee, we have two updates, at least for the NASDAQ 100. The S&P 500, we're looking at the first up day in 5 days. The NASDAQ 100 off of its highs earlier on the day, up more than 1%, the best day since last Monday. And this, of course, has a lot to do with NVIDIA. The shares are really on fire today, up more than 14%. The best day since March 24th of 2020. It has everything to do with their outlook in terms of it being more about the AI processors and looking for more revenue than what the street had looked for. If we take a look at not just NVIDIA on the year, but Tesla and some other movers, take a look at this. This is incredible because we're not even full 2 months into this year. We have Tesla up 63%, NVIDIA up 63%, Meta up 43%, and then Seagate, the memory company, up 27%. And I would suggest that last year the expectations were so poor that now that some of the results from these companies have come in, the idea is the worst is behind us. But one big question, of course, has to do with the Fed, liquidity. How much will they be hiking? Goldman Sachs a couple days ago talking about 25 basis points over the next 3 meetings. And of course, we just had that solid jobs data in terms of continuing claims and initial claims coming in lower than expected. So the Bloomberg expectation for labor conditions coming in very high relative to the overall economic surprise. Tomorrow, of course, we have PCE, core PCE. It's going to be interesting to see whether or not that moves the market. Now, we're just looking at the 1 month or year-to-date moves for some of those big tech movers. Take a look at these sectors because with the move of NVIDIA, we do have the chips really outperforming, up 17%, and then technology, tech, and software. And Guy, this is such a turnaround from last year. Energy down on the year after 2 big up years in a row, gaining more than 100%. It seems as though at least right now it's technology's time to shine. And what makes it so interesting, we of course have yields backing up in a big way, but investors looking past that valuation risk.
Absolutely. I'm sure Kathy Wood is delighted by the move that you're talking about. Oil prices up a little today. Abigail, thank you very much indeed. Cliff Asness is minting himself as the king of the quants. He comes off a record year for a dozen of his funds. AQR's founding principal joins us now for an exclusive interview. Joining him in the studio is Bloomberg's Sonali Basak. Sonali, over to you.
Thank you so much, Guy. And Cliff, thank you for joining us. You know, to be fair, it was The Economist that minted you recently.
Yes, I reject that label.
The king of the quants. But, you know, when you think about it, you are coming off this record year. At least a dozen funds here coming off record performance. Do you feel vindicated by the strategy at all?
I personally don't know what feeling vindicated really feels like. I feel, I guess, partially vindicated. You know, it's very nice that you guys talk about what a great year it was last year, but 18 through 20 was terrible for us. We've made all of that back and more. So yeah, there is some vindication in that. But frankly, I think there are a bunch of things we trade that are still pretty dislocated. So I don't think I ever will feel fully vindicated. That there's a sense of being at peace with yourself that I just will never attain. But another year or two that I expect, I'll probably get a lot closer to feeling that way.
What have you learned over the last couple of years to the point you're making? It was a couple of tough years before you got into that rebound.
Sure.
What have you learned, and do you have any faith that gives you the sense that you're going to keep this performance up this year into next year?
You know, I guess one major thing we learned is exactly how wrong I can be. We started our firm about an hour and a half before the 1999-2000 tech bubble. If your viewers can't tell, I'm pretty old. I know most people have not experienced that live. And it was a terrible start for us in a very similar environment through 18 through 20. We came up with measures to go, how crazy is it? What are the, you know, you can always sort stocks by your favorite valuation measure. You know, you pick your own, price to sales, price to earnings, price to something more proprietary. You can always get cheaper and expensive. In the tech bubble, they went to crazy differentials. If you had asked me back then, will I ever see that in my career again? I would have made one of the classic mistakes in finance. In fact, I implicitly did make this mistake, even if nobody asked. I would have said, nah, that was the 1 in a 100-year craziness. And then, even before COVID, but certainly with COVID, we saw something on our measures considerably crazier than the tech bubble. So it was yet again, it's a lesson we all have to learn multiple times. Markets can be crazier than you think.
How much are we still in a bubble right now?
Okay. I could torture everyone about how to define a bubble. No one really knows. I loosely think of it as prices where you find it's you have to make very, very unrealistic assumptions. You can't come up with assumptions you think are at all reasonable to justify these prices. I think the difference between cheap and expensive stocks, I don't like calling them value versus growth because sometimes the cheap stuff actually grows, but value versus growth as the world calls it. I would use the word bubble for where they were in late 2020. I don't think, looking at all of recorded history, there was any outcomes in fundamentals that would end up justifying that. The stock market at the end of 2021 and the bond market, 60-40 portfolio, we thought was priced to its lowest expected return ever. Stock prices were very high against fundamentals, and bond yields compared to expected inflation, even before inflation took off, were very low. There, I'm a little less willing to call it a bubble. It is possible the world wakes up and goes, we'll accept a lower return. More savers than consumers, blah, blah, blah. I would say the stock market and value versus growth have come back decently, but the world is way too quick to see 1 year and go, all right, we're done with that, we fixed it. They had 10 years of going the other way. So I think both of those, I think we're probably still in a bubble in cheap versus expensive. I wouldn't call the overall market a bubble anymore. I would just say it's a very expensive market.
Cliff, good morning. It's Guy.
Hi, Guy.
Okay, let's talk about timing then. So we've had a year, and things have started maybe to recalibrate. But as you say, the previous period was 10 years long. So how long could the current period last?
We do find in general, and some of our investment products are explicitly built around trend following, even though I talk about value all the time. Whatever's been happening does tend to keep happening in the same direction, at least a little more than it doesn't. And when you see really crazy things, which again I think is fairly rare, and again an ex-University of Chicago guy like myself doesn't like the word bubble, but when you see things that you think are bubbles, they take a long time typically to reverse. You don't come in one day and find the world's just back to what you consider normal. A lot of people believed in it. A lot of people think once it started to move, they're getting a bargain. And the bargain is buying something that's 20% cheaper than last month, but 300% more expensive than it should be. So I tend not to make great hero timing calls. When I've tried, I've had to write apology letters 6 months later. Even with calls that are ultimately worked out and we stuck with. It's very hard to the market can do whatever it wants in the short term. But I do think it is more likely this continues. And from a portfolio perspective, you don't know. Sorry, go on.
So with the benefit, okay, so it looks like we've had a pivot. You're spending a lot of time talking about sort of time here, but you don't want to talk about timing because, as you say, that's a difficult thing to do. But with 1 year of hindsight, do you think we have had a pivot and the market has changed? This is a fundamental shift in the way that we should perceive the market. This is a timing shift as well as a valuation shift.
All right, I'll take more risk with my next comment. First of all, yes, over the last year we certainly saw a huge shift. We saw the market reprice to cheaper and the differential between very expensive and very cheap stocks come in fairly dramatically to still an extremely high differential. So that's the part you got to keep in your head. It's come in a lot. And yes, I do believe this will continue. I just feel much stronger about diversifying and making sure you have exposure to this. There's always a chance that the trend reverses for 3 months before it continues again and people panic. Almost every correction we've seen of big dislocations have had some massive kind of rallies back towards crazy within them. So there, I've learned to be scared of that. But yeah, I will go out on a limb and say I do think you want this now.
So let's talk about the risks that we may not see on the surface. You went to the Chicago school. I went to the Tom Keene school, apparently. And so he's asking about the epsilon. What is the systemic risk? The fat tails that can kind of complicate your investing thesis and, frankly, the investing thesis for a lot of the market. What keeps you up at night?
Okay, I'm not a macroeconomist, and sometimes I do try to play one on TV, and I always get myself in trouble. But I think the fat-tailed event probably is macroeconomic. The world is currently thinking inflation comes down a lot. You know, we see 5% cash yields, but inflation's still running around 6% now. You're still getting a negative real yield on cash. Equities are still priced very high versus history. So they're kind of priced assuming inflation comes back down, and that doesn't really affect their top line. Because if inflation comes back down, there's some pricing power to that. It gets political. A lot of people complain about the pricing power of corporations in inflationary times. So I won't be courageous enough to make a prediction, but I will say there's a risk. May not be disastrous for the world, for the average person, but there is a risk that the macroeconomy delivers results that markets are still woefully unprepared for.
So how do you prepare for that then? I mean, if you think about the 60-40 assumptions you've recently made, you have started to pitch more diversification. It's not great in terms of historical returns, of course. You're expecting 3% over the medium term. But what's the case here to buy bonds? What's the case here to take on risk in this market?
First, it gets back to the cowardice over timing. 60-40 for one. I don't know anyone who actually owns a 60-40 portfolio, by the way, but we're all legally required to speak about 60-40 if we talk diversification. I think it has a positive expected return. You said 3% is over inflation. I can't prove that's lower than history, which has been more like 4.5, but it was 1.9 at the end of 2021. And that I thought, again, I'm a little scared to call it a bubble, but I thought was pretty extreme. So I don't think you want to have, certainly not know or short these markets. There's still a risk premium and you can't time it. Almost by definition, and I apologize for this, my recommendations will sound a lot like what I do for a living. I find it almost impossible because we're allowed to do different things. It has to be that way. But I think this value trade, as Guy asked me about and got me to go out on a limb on, still has quite a ways to go. We prefer adding some to a portfolio that is actually a little bit more of an alternative. Long, cheap, and short, expensive. That dramatically lowers pretty much to zero the correlation with markets, and you're really only taking a risk on the differential. And we still like trend following. A macroeconomic volatility tends to be good for trend following. One of the problems trend following had post-GFC was about 9-10 years of unidirectional, boring, nothing going on.
Right, and I want to copy on that for a minute here because you have, for example, one of your big rivals in the market, if you will, a letter from Universa to investors recently talking about kind of trend following as a hedge here, as a hedge over a long period of time. You've acknowledged that it hasn't always worked out.
Oh, yeah. You mentioned Universa. What I don't know exactly what they do. It's shrouded in secrecy. But a fair amount of it is always being what's called long volatility. The simplest version of this, which I'm not saying is what they do, is to always be owning puts and rolling them. That is one form of insurance. It has two aspects. It really only insures, and this is good, but it only insures against short, sharp crashes, because that's what it is. Second, it's a bad property. We believe it costs you money long term. And we think that just makes sense. If you want insurance, you should have to pay for it. Trend following doesn't always work. As you said, in March of 2020, when we saw a gigantic drop and then a comeback immediately, it wasn't a disaster, but trend following didn't protect you because there was no trend to follow. Trend following has two other aspects, though. It does particularly well in long, extended, tough markets, because by definition there's a trend to jump on. And I think those are actually more important than crashes, frankly. They're more damaging to long-term wealth. Second, in our real-life experience and in 200 years of backtests, it actually, unlike buying puts, makes you money on average. So it is imperfect insurance, better insurance at a longer horizon than puts, and pays you instead of being paid. But I'm not totally against a portfolio of the two. Someone who wants to really insure against tails might want to do some of both.
That assumes, Cliff, that the market is functioning. Liquidity is tightening right now. Are you seeing any impact from that? Is that something you worry about? Sonali mentioned the tail risks out there. How do you see? Do you see a risk coming from liquidity, and how would you see that affecting you?
Yeah, I mean, I've worried about this since Graham Dodd, when we had to move a lot of position risk away from banks, and you know, where'd that buffer go? We do see liquidity getting a little bit worse. The cleanest place to measure it is probably the over-the-counter bond market. They're not dramatic, but we see bid-ask spreads wider. But we also see volatility, and we don't just, everyone sees this, being considerably higher than the past. And bid-ask spreads are almost always going to widen when volatility goes up. What a market maker does is take the other side, buy at the bid, sell at the offer. Oh, I got that right. Like 3/4 of the time I get that right. I've been doing this 30 years. Sometimes I still get that wrong. So they buy at the bid, sell at the offer, so they make that money, but they can't get out of it immediately. They take the risk it moves. So when the world is more volatile, they're facing more risk. They widen bid-ask spreads. And that part seems fairly proportional to us. Meaning liquidity has, bid-ask spreads have widened, meaning liquidity is lower, but it's not out of proportion with the markets we've been seeing. If it does move much more without the markets getting crazier, we would really start to worry. But as of now, it's something to watch, but not one of our major worries.
Cliff, if we're worried about liquidity, why don't we just invest in private equity? Then we don't have to worry about liquidity.
Well, now you're just baiting me, Guy. I know what
I like to do here.
Yeah, I know it's going to work. You know, I have written about private equity. I do start everything I write about it, everything I say about it, with the absolute truth that I'm a believer it should play a big role in our economy. There are companies that shouldn't be public, that need a diffuse set of owners, that shouldn't be a sole proprietorship also. I think many of the private equity investors are very good investors. They're very good at identifying value. I think they get over-demonized. It's ugly sometimes, but they do some of the necessary creative destruction that capitalism, as Schumpeter told us, thrives on. Those are all the nice things. I'm getting to your stuff, guys. The part that worries me is I do think 30 years ago, call it, David Swensen of Yale era, private equity was almost exclusively bought as a return enhancer. These things are cheap and are going to make more money. You got an illiquidity premium. You got paid more in return for accepting the fact that you can't get out and you're not told the accurate prices. I do think that what used to be a bug, people said, oh, I don't want illiquidity. I'd like to be told the prices, but I want the return. They have learned to see as a feature. Not being told is the prices, and not being allowed to get out has some positives, right? It can make you a better investor if you're not allowed to do something crazy. It comes at some costs. One, if that's what's driven the popularity, it is possible the liquidity premium is now backwards. You get paid for accepting a bug, but if now something is viewed as a feature, you pay for it in terms of getting a lower expected return, at least than you did in the past. Second, I'm not calling for this, I don't want to be a doomsayer, but in the disastrous event, I mean the 10, 20 years of down to flat markets where we get, we end up in 1981 with the death of the equity market kind of things, it's going to catch up to private equity. They are ultimately at least beta 1 or possibly larger levered equities. So they are running a bit of by adding them to a portfolio that already contains public equity. And sometimes you see institutions with very low volatility assumptions for private equity. They are kind of running a risk that will probably work because these are rare events, but a risk that there's a true, very long-term disaster, and people find they had 70%, not 50% equities.
Are you saying there's another shoe to drop in terms of valuations, given we haven't seen the same move in private equity, number one? And number two, I mean, you call this volatility laundering, very famously. Do you think that investors would think twice after we're seeing some of the gating of some of these interval funds, after you saw some of the big implosions, like with FTX?
Yeah.
Do you think that that will cause investors to think twice about private equity?
I don't think we've seen enough to materially change investor behavior. So far, if I'm right, and I admit I'm a little cynical, and I admit I have a weakness for inflammatory, cute phrases like volatility laundering, it's worked so far, right? The reported return swings are much more muted, and if we recover from here, then the drop never happened. and it was successful. So I wouldn't necessarily say where people have learned a lesson. I think some have started to look and go, we should really talk about this. And that's the beginning. But unfortunately, and I'm really not rooting for this, a lot of aspects of my business would not enjoy this either. I think it would take a fair amount of more pain to really demonstrate to people that they're taking a risk they didn't realize. Your other question was, is there another shoe to drop from valuation? There I'm going to tell you a very firm, I don't know. Because my position's not actually that they overstate prices. It's that they just don't move them enough. It's a little less nefarious than maybe it sounds. If you don't move them enough, it's possible, and I do not know, that they didn't move them up enough in a very long bull market. And the stability you see now is eating into that bank account of underpricing. So I wouldn't necessarily say there's doom about to come. It could be, but they could be now fairly priced. They could have used up some of that buffer. I'm not brave enough to make that call.
Cliff, I needed to know, because you had been talking about, the whole market not being in a bubble anymore, but there are certainly pockets of them. Where are those pockets? You are known for kind of being vocal about how all the animal spirits have started to engulf the markets. So where are you still concerned?
I'm boring. Our old measures of valuation, looking at cheap against expensive, we do it, and other people do it very different ways and frankly come up with some similar conclusions. But we do it using multiple measures of value. Very often value gets pigeonholed as price to book, and then everyone likes to pillory price to book, and that's value circa 1990. So many measures, and the way we do it, we don't allow a very big sector or industry bet. We believe in comparing apples to oranges. Apples to apples. You don't want to compare apples to oranges, though it might be an interesting comparison itself. That spread, apples to apples within industries, looking at a multitude of valuation measures, is still at the 90th percentile versus history.
Though, right? I mean, recently you had said on Twitter, Bond villain goes after messianic cult leader in an attempt to permanently undermine capitalism by reinflating a bubble that's still barely defeated. Do you think this is a matter of kind of retail traders pumping up the market? Is it a matter of, non-profitable companies propping up a market? Or is it leverage still propping up this market?
Well, if you're going to quote me, that's just unfair. And that was attempted humor, by the way. But yeah, I do think the overall stock market, kind of the cap-weighted S&P, Wilshire 5000, whatever you want to look at, maybe I'm a little more careful on the word use of the word bubble, but I still think it's very expensive versus history. And yeah, those managers and who jump out and say it's much cheaper than insane, so you got to buy now, buy the dip. I prefer to look at actual values as opposed to changes in value. So in a little bit of a provocative, puckish humor way, that is kind of what I was trying to get at there.
Cliff, final question from me. You're a smart guy. You've been doing this a long time. The last 24 hours...
Well, I agree with half of that, but go on.
Okay. I'll let everybody decide which half. We spent a lot of the last 24 hours talking about AI. Do you think a computer could do what you do? What do you think about what is happening in technology and the way that it's going to have an ability to change this market, to analyze this market in a completely different way? How do you see that? How do you invest in that? How do you think about it?
First of all, as good as ChatGPT is, no computer is going to be able to make an ass of itself on Twitter quite as well as I do for a long, long time, as you just pointed out. There are places we are absolute users of AI and machine learning. Natural language processing, being able to trying to extract information, which often looks like traditional momentum trading, just another aspect of it from, say, corporate statements, where there are way too many of them and it's way too subtle for a human to do it. And many other examples. At the edges, we think there's going to be a lot of return to people who are good at AI, and we hope to be one of them. Where AI is not going to change things, in our opinion, is stuff like what's the average premium for cheap versus expensive stocks. And we believe it's fairly positive. Some others disagree. But AI, that's a small data set, not a big data set. You need AI when you have big, unstructured data. And a lot of the central problems in finance, Should I bet on this phenomenon? Cheap beats expensive. I'm picking on one. There are many others. And should I stick with it when it's not doing well? I don't think AI is going to tell us the truth on that. I think a long-term history and whether it makes economic sense to yourself is still going to be the way to go there.
Cliff, in just a minute here, before we let you go, you know, it's been a wild ride the last couple of years. Is there anything you would have done differently?
Yeah. In late 2019, we've always called timing, stock markets, or factors like value and investing sin. And we've always added a little, wry joke, and we recommend you sin a little and occasionally. To all your viewers, it's also what I recommend in your personal lives, but that's a different question. Meaning when prices are truly beyond egregious, that bubble you think you can identify, not even necessarily the 100th percentile, because the 100th percentile might have not been that crazy in the past. I jokingly sometimes call it the 120th percentile. Hopefully most of your listeners and viewers know that there is no such thing. But, well past the past, can't justify it. In late 2019, I said it's time to sin a little in value, to have a little more value. 6 months later, roughly, I don't remember the actual date, I had to write a piece saying no sin has ever been punished this violently and this quickly. I will make an excuse. A little thing called COVID happened, and whatever value versus growth was trading at, the world decided all you needed was Tesla and Peloton, and it exploded way worse. But it did show some of the sins of timing, and it also showed, and I admit this, I had a great fear, and we talked to our clients about this, that it could all come back very quickly. Normally things are slow, as we were talking about before. It takes multiple years, but that's normally. Next time it could just come back in a melt-up, and I was very scared we'd miss that. And that was part of the timing. I think I should have trusted the trend aspect of what we do. I mean, again, it's actually been a good ride, all considered. I think it's going to be a great ride, but it would have been even better if I had fully trusted that.
Cliff, it's been so fun to have you.
I hope you've enjoyed this. Yeah, I hope you've enjoyed this as much as we have.
I certainly have. Thank you.
Fantastic to have you here on Bloomberg Television. Cliff Asness, AQR Capital Management Founder and Chief Investment Officer. Sonali, great stuff. Thank you. Thursday, February the 23rd. European equities broadly rallying. London's a little bit of a laggard. The drugs aren't working today. It's names like AstraZeneca that are adding some weight to the downside. Plenty to discuss. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So let's take a look at the markets as we head into the close here in Europe. Stock 600 is up by 0.2%. It's not exactly a great rally, but there is some green on the screen after some dismal days for equities. 463 is where we are now trading. London is a little bit of a laggard. As I say, it is some of the big drug companies that are acting as a bit of a break for the UK. But apparently the UK under Keir Starmer would become the fastest growing economy in the G7. We're going to talk about that in just a moment. The German 10-year, the bonds have got a bid. Despite the inflation data we saw out of the Eurozone today, Germany a big factor in those numbers, but the core number continues to track higher. That's going to be further ammunition for the hawks. And then we come to some of the good corporate stories today. Rolls-Royce is one of them. John Wood is another one. That stock is up by over 30%, Kaylee. Apparently Apollo has asked not once, not twice, but 3 times for a takeover of this business. They've all been pushed back. That news sending that stock sharply higher.
Yeah, absolutely flying. We aren't seeing any moves really of that magnitude when it comes to large caps here in the U.S., Guy, but by and large, it is an up day for equities. The S&P 500 right now attempting to snap what has been a 4-day losing streak, just fractionally higher by about 0.25%. We are right at that 4,000 level, but beneath the surface, there are some big movers, including NVIDIA. This move is absolutely remarkable. We're talking about a 14% gain on the day. That's about $60 billion in additional market cap. This is now a stock worth more than $200 billion more than it was at the start of this year. And remember, February isn't even over yet. Absolutely remarkable move on the back of a bullish forecast. The company really being aided by AI. Go figure. In the bond market, though, literally nothing going on in treasuries. The 10-year yield is unchanged at around 391. And then in crude, this is noteworthy just because this is also a snapping of a losing streak after 6 consecutive days of losses, 8% down over that time. We are seeing a bit of a comeback for WTI, up about 2% on the day to 75.54 a barrel, Guy.
Katie, let's talk a little bit about the UK economy. I mentioned it just a moment ago. The UK economy has been something of a laggard. Certainly in the post-pandemic era, it has struggled to come back to where it was pre-pandemic, while others have hurdled that level, not with ease, but they've certainly achieved it. You can see that in the chart in front of you. It has been a difficult run. Britain has underperformed. The Labour Party wants to change that. The Conservative Party wants to change that as well. In fact, we certainly heard that from many past prime ministers. But the man who's widely tipped to be the future prime minister of the UK, if you look at the polls, made a big speech today up in Manchester. The Labour leader, Keir Starmer, spoke in Manchester, and he has promised that under his leadership, the UK will achieve the highest economic growth in the G7 by the end of the Labour's first term. He's anticipating, apparently already planning for, a second term were he to win that initial election, which gets us to our question of the day. How does the UK grow faster? It's not an easy answer, let me assure you. Joe Mays, Philip Aldrich had the politics and the economics covered for us here on set. Joe, I'm going to start with you. How significant was that speech by Keir Starmer today? It was long on expectation but light on detail. What did he actually promise?
So the big idea was these 5 missions. It's Labour setting up the framework for what they're going to offer the country going into a general election next year. But like you say, very light on detail. I mean, Keir Starmer's pitch is that we will bring stability back to UK politics such that investment will start to flow again. They have this big agenda around green tech and making the UK a future superpower in the world of clean energy. But like you say, it's still not very fleshed out because they're a little bit worried about the Conservative Party stealing their ideas ahead of the election. But yes, it's the beginnings of that policy platform that we saw today.
Well, and of course, what we're talking about is fiscally oriented policy and expectations on the growth side. We also have to consider monetary policy and the fight against inflation and all of this, which brings me to the Bank of England and what one specific policymaker from the BOE, Catherine Mann, had to say today about more interest rate hikes being needed. Just take a listen to that bit from her.
Monetary policy has been historically aggressive, but perhaps insufficiently so relative to the multiple shocks, the behaviors pushing up inflation, and the initially accommodative starting point.
So, Philip, to bring you in here, how does what Keir Starmer would like to achieve track or not track with what the Bank of England is trying to achieve?
Well, I guess there's two different timeframes here. The Bank of England is trying to get inflation under control at the moment, so there's like a 2-year outlook. By that point, we're actually going to be going into an election. So then Starmer's looking over the subsequent half-decade, and I guess so. How does can he make us the fastest G7 growing economy? I mean, there is a possibility. There is one way. I thought of one way. It's a difficult challenge, but we have a productivity deficit in the UK of about 20%. Compared with the US and European peer nations. If we can catch up all of that 20% productivity deficit, we could actually be, the fastest growing G7 economy sustainably 4 or 5 years. Now, getting that 20%, making up that 20% deficit is incredibly difficult, and obviously we've been trying to do it since 2010 and completely failed. So the only ways sort of seemingly available are massive levels of investment in high growth industries like tech and maybe clean energy. So I mean, you can map a route there, but it is enormously ambitious to set a challenge.
In some way, that's where we track between Mann and Starmer. The reason why we have an inflation problem in so many ways is because the economy can't drive fast enough to generate the kind of growth without shaking and bits falling off it, which seems to be the kind of the position that we're in at the moment. Starmer was very keen to point out that Brexit is not the lever that you want to initially think about. He says there's a laser-like focus on it. You shouldn't have that laser-like focus. Is he correct in thinking that? What impact would a better relationship with the EU have when it comes to solving the productivity puzzle that you're talking about?
Well, in theory, if we can get this Northern Ireland Protocol fixed, and we can get basically remove the uncertainty of a potential trade war, replace that with the possibility of closer, amicable ties with the EU, you can release some of the investment, because businesses are sitting on close to 100 billion more cash than they were at the start of the pandemic. They're not going to spend all of that, but we have had flatlining business investments since 2016, since Brexit. So if you start to release some of that, and sort of navigating to a position where that happens, unlocking any remaining Brexit uncertainty could be part of that. So it plays a role. Brexit is definitely there.
And Joe, what about the role of the weather? And perhaps I am a little biased today because I'm sitting here in Washington, D.C., where it could reach 80 degrees Fahrenheit by this afternoon, which I think is, Guy, correct me if I'm wrong, like 28 degrees Celsius. Something like that. But I mean, it's been incredibly warm, which has helped with the energy shortage. But there's a question of, the winters of the future. I mean, how does the weather dynamic color this conversation in the near term and then over the more medium term as well?
Well, certainly immediately it has an effect for the Chancellor Jeremy Hunt in terms of having to spend less on energy support for households because gas prices have come down, and also because they're using energy less because it is warmer, as you say. But he can only bank that in the very immediate term. It can't influence him too much. He's thinking about that longer term picture, how sustainable the public finances are. And yeah, the weather will not come to the rescue all the time.
All right, well, it's certainly coming to my rescue today because I'm really looking forward to going for a stroll outside after the show. Thank you so much to both of you, Joe Mays, Philip Aldrich, both from Bloomberg. We appreciate your time. Now, coming up, we'll get more on our question of the day. How does the UK grow faster? Nanette Heller-Fadherbe, Credit Suisse CIO for EMEA and Head of Economics and Research, is coming up next. This is Bloomberg.
Today, the global spotlight is on India as the G20 financial leaders gather. Among the issues on the table, debt relief, inflation, climate sustainability, and more. Live coverage continues on Bloomberg, your global business authority.
The fastest growing economy in the G7. That's what Labour Party leader Keir Starmer would like to achieve, as he outlined today. The question is, and it's our question of the day, how do you do it? How does the UK grow faster? Joining us now is Nanette Heschler-Fedherb, Credit Suisse CIO for EMEA and head of economics and research. So Nanette, if we could begin with the UK and the growth picture there, is this actually achievable and how?
I mean, when you look at what is driving really the potential of an economy like what we are talking here is the potential. It is how business friendly an economy is, how much it is able to drive capital flows in, as well as talent coming to raise productivity. All of that is participating to make an economy grow faster over time.
What do you think is slowing the UK, therefore, down right now? Why is the UK not fulfilling its potential?
I mean, there is a confluence of factors right now. One is that obviously when you think about most developed economies like the UK and others, consumers are playing a big role. And when consumers are faced with an inflation shock, they are, of course, restrained in terms of their consumption. So to get back also inflation onto a path that is giving consumers more purchasing power is really one of the immediate goals, and is also what is holding back the economy at the moment. But then there is also the ramifications of Brexit and what it has done to the ability of the UK economy to be really on this growth, long-term growth path, on this potential as well.
Yeah, a longer-term growth path, but in the more immediate term, as we were discussing earlier with our internal panel here at Bloomberg, is the challenge of inflation. And we heard Catherine